Hey everyone, welcome back to the channel once again. Welcome to another fantastic week, and this week we are continuing with valuation, not looking at DCF anymore. We've covered that, 2 videos, and now we're going to look at market-based valuation. So this is another approach that the industry uses for valuation. It's actually pretty useful in everyday life as well, and we'll look at some examples in this video of how you can use it in everyday life. And it's not applicable for every situation. Again, that's why there's 3 different main topics of valuation and 3 different methods, main categories. So this week we'll be looking at that. So I hope you enjoy this one, and I'll catch you guys next week. Welcome back to the channel, everybody. This week we're talking about market-based valuation, turning away from income-based valuation now and looking at this instead. This is the second category. So the market-based approach at a high level is the second of 3 types of valuation that we're going to cover on the channel. As I mentioned, we've already covered income-based valuation the last 3 weeks, and we're going to cover cost-based valuation next week. Market-based valuation is the most effective when it's in the context of having many comparable transactions, as they're called, to compare with the current transaction that we're looking at. The main reason for this is because the fair value, as it's called, of a business or asset is best determined by looking at the price of transactions that took place for something similar in the free markets. So this fair value is more or less the average price based on transactions in the market. Now, assets are historically much easier to value using this valuation approach than businesses are, and we'll see why in a moment. So for example, real estate is much easier to find similar transactions than a large tech firm is, and this is because they're bought and sold much more often than a large tech firm. Again, this is due to the number of available comparable transactions. Usually there are many houses to compare with in a single area, but not many large tech firms, and this makes them harder to value. Let's take a look at some advantages and disadvantages of this. Market-based valuation has a leg up on the other methods that we're going to look at or have looked at. In terms of valuation, since it aims at point-blank type valuation. Now what does this mean exactly? It means it doesn't require many, if any, assumptions, which is much different than DCF valuation, for example, which requires a lot of assumptions about the state of the world and the company. Another advantage is that it's fairly easy and straightforward to implement, and even very entry-level analysts can conduct this kind of valuation. This holds true as long as various comparable transactions exist in order to compare to, as we've mentioned. So what we do is we simply compile data on comparable transactions, and the more that we have, the more accurate the valuation will be, since we get a more accurate fair value. And we can then come to a conclusion for the fair value or market price of the business or asset based on these transactions. The main disadvantage of using this type of valuation method is that oftentimes we want to value a business that does not have many or no comparable transactions to utilize in the valuation, and this renders the method virtually useless, and we have to turn to cost or income-based valuation instead. Now, this is especially true for private businesses or large corporations, which often don't have many transactions to be compared to, and they're not bought and sold very often. So now we can take a look at an example here. Let's take a look at how we can use the market-based valuation in our everyday lives, and this will make it more useful for all you watching out there. So consider that you're looking to buy a car, and you are not sure whether or not the seller's asking price is reasonable. This is often the case because we know there's a lot of price gouging in this market. The market-based approach actually allows you to collect data on similar cars or the same cars produced in various different years and for transactions within a certain time period. So it could be the past 6 months, for example. We can then compare them to the vehicle we are wanting to purchase and come up with a fair market price. So things you might want to consider when doing these comparable transactions is things like mileage on the vehicle, whether the brakes have been serviced or tires are aged, major servicing that's been done, and the state of the interior, or whether the person was smoking or non-smoking in the vehicle. And looking at these various comparable transactions of sold cars in the past, say, 6 months, can give a clearer picture of the fair market price for the car to determine if it is in fact overpriced, and therefore we can negotiate with the seller. So as an example here, say we want to buy a 2012 BMW M3, which is being sold privately for $60,000. Now you think this might be a bit overpriced, but you're not really certain if that's the case. So what we can do is look at a range of years for BMW M3s, build years that is, so 2009 to 2015 is what we've chosen, and transactions taking place over the past 6 months in regard to this, as well as their mileage, the major service that have been done on those cars, etc. And we can look at comparing to the vehicle that we want to buy in this way. So what we can do is create a chart to compare the various aspects of each car, or even an Excel file if we wanted to arrive at a fair market value for what this particular M3 brings to the table. So let's say we look at some transactions and we see that a 2009 M3 sold for $30,000 with 50,000 miles. Sorry, $30,000 for 50,000 miles, and a 2015 M3 sold for $55,600 with 100,000 miles on it, with perfect service history and new tires. Now, if ours, on the other hand, has 60,000 miles and it has worn tires and brakes, we can pretty likely conclude that it is overpriced. But again, this is only using 2 comparable transactions. We determine this by considering all aspects of each car. Now, having many transactions for M3s in the same year range, say 100 of them, would provide a very accurate market price to determine if the asking price makes sense. And generally speaking, the more rare and unique an asset or business is, the more difficult it is to implement market-based valuation. So I hope that helped a little bit, and I'll see you guys next week.